Wake up, motherfucker.
Oh, what's up? What's up, guys? All right. Holy shit. Let's see. Okay. Axios say anything? It's May 7th, 2026. All right. Everybody's dogpiling the guy from Axios, that Israeli guy, saying, like, insider trading. Bro. He's done it 100 times already. You guys haven't caught on to what he's doing. He always tacos 4 hours before market open. Taco time, taco. Oh my god. Anyway, yeah, they're all over on Twitter dogpiling this guy. Let me see. Let me get the chart up, and then okay, got that. Then let's see. Got my image. Okay, let me show you the culprit of all the haters. All the haters. They hate the taco, but it's the only trade that works. I don't understand it. Everybody over the weekend was telling me, no, taco can't work again. Yeah, it worked again. What the fuck? You guys are stupid, man. You guys really think Trump's gonna do anything? Come on. Right here. This is the guy you want to hate, I guess. So Barak Ravid used to be with Israeli intelligence unit 8002 or whatever they call it. What is it? 8. That's their signals intelligence. A lot of those guys actually go and move on to Silicon Valley, cybersecurity type work. So they're all over like the San Francisco Bay Area. Let's see. 8004 Israel. What is it? I think it's the 8004 unit. What is it? Oh, 8200 unit. Unit 8200. That's their version of signal intelligence, NSA, GCHQ. Okay. It's also called the Shimone Mitayim. Whatever. All right. Okay. So and he worked for Axios, and Axios is one of those little news aggregator type sites, I guess. I usually look at Axios. Axios always has nice summaries, so I always go to Axios for my news. I didn't know all of them were just like bunch of Israelis and insider traders. All right, I guess everybody noticed them now, and they're getting pissed because he did it like way too many times already. Every time 2 to 4 hours before market opens, taco, and then the market starts pumping before the market opens. Oh man. Oh, rumors that Pakistan is hosting talks and whatever, or this and that, and blah blah blah. Crazy, bro. Yeah, there's huge threads about it on Twitter, all over Twitter now. I don't know why they dude, he did it already so many times before. Why you guys care now? Is it because you were all long oil or something? What the fuck? Why do they get pissed off now, man? Was everybody long oil? Like, I don't know. Was everybody short semiconductors or something? Is that why everybody's pissed? Remember, do not short a bull market. Do not short a bull market. Like, if you're short, you're just in there for a couple days and you get out. Honestly, it's like you think this thing will just blow up and go down. So I did short semiconductors yesterday because I had profit in HUT. So I sold HUT, and then I said, well, I made money, so might as well just dump it into semiconductors just to gamble a little bit. Why not? Because look at the way semiconductors was going. Like I told you, like the last time I shorted was up here. You see this? It's very far away now from the yellow and purple lines, right? Like if it hugs close to the purple line and you don't see real red bars, you can't really do anything. The last time we had real significant red bars was here. This was the last attempt at like trying to crash this market was April 15th. And it didn't happen. Like 2 red bars here on the 78 minutes. So 0.71%, 0.79%. and then it gave it all up in the next 2 bars, like, and at the end of the day, it just closed like this. You see this? It just overlapped those two. Like, what am I supposed to say about this? Am I thinking I'm gonna short it? No, doesn't look so. Like here, when you got the Intel pump, it's like, okay, now it's too far away. It's gonna have to pull back at least, right? So it pulls back, but you see it didn't break the yellow, okay? And then now we're here. All right, we've went too far. Okay, we went too far yesterday on that taco plus AMD. Yeah, I think AMD plus the taco at the same time was not a good idea for anyone to go long here. You're gonna have to wait for it to pull back. Now, okay, will you get a second day? That's the question, right? This would be a good short from yesterday. You would probably be like, okay, I got my profit. I'm done. I'm out. Now, if tomorrow people still want to sell semiconductors, because again, there's no more real earnings. Like AMD was it. You got 2 more weeks until Nvidia, 3 weeks until Broadcom, Marvell, 4, 5 weeks until Micron again, and that's it. Oracle, right? Maybe 4 or 5 weeks. Oracle in June, sometime in June. So Oracle will be the next big hyperscaler data center type of spending number that people want to get, because remember, they have Facebook, you got Google, you have Microsoft, you have Amazon, and then you look at Oracle. So those are the 5 big boys that spend a lot of money on data centers for the cloud AI infrastructure, okay, in America, in the United States. Everybody else are just small potatoes, okay? Everybody else are just small potatoes, like Hut, like whatever. So now we got Hut here. We got our pump, okay? That's 30 something percent. I told you guys when Hut wants to go, it's gonna go big. You're gonna see like pump 30%, and then another pump 20%, another pump 20%. Like this thing is gonna go even faster than any of the semiconductors. It's easier to push up, okay, because it's a smaller company, meaning it has less shares, so it doesn't take much volume to manipulate it up. I don't care what you call it, manipulation, bubbles, people just chasing. It doesn't matter. Like once you do this breakout, you're gonna win. So here, let me show you this. Okay, let me take away indicators here. Just look at the chart. Just look at this chart. Just look at this chart, right? We've been up here back in 2021 and we just broke it yesterday. Okay, so we just broke it. So now there's nothing to stop you. Nothing to stop you. Now compare that to MSTR. This is why I said I'm not really big on MSTR. MSTR still has to fight through all this stuff here. People bought here, people bought here, people bought here, people bought here. All those people that bought here are probably going to sell when it gets to their price. They're going to be like, oh, thank God I broke even, get out. Oh, thank God I broke even, get out. Oh, thank God I broke even, get out. So even if Bitcoin goes crazy, which I don't think it will, like it's just going to go up to 100K, this thing is going to have a hard time getting through this mess. This is a mess right here. A lot of buy the dippers over here, and they're all itching to get out. These guys probably look at semiconductors and go like, damn it, I should have been in semiconductors. Why did I buy Bitcoin over here? Right? And they're just like gonna jump out. All this money is probably going to semiconductors again later on in July. They're gonna chase semiconductors. I know psychology, man. You have to treat all this as psychology, right? You got like the people that bought here got out here. The people that bought up here all the way down here, they're losers. They're suckers. And now the people that bought here, they're probably gonna start getting out already once it starts climbing. So the people that are trading this just to get out over here are the same people, like the types of people that are over here trying to get out at break even. So this adds a lot of pressure over here, right? This adds a lot of pressure here. Like, so this is going to be a tough time when it gets to 195. It's just like it's going to struggle. The only way it's going to really zoom back up is that like there's no brakes on Bitcoin. Bitcoin just flies up. No brakes. No brakes. Bitcoin needs to just get to 100K immediately for people to just change their mind and go like, okay, maybe Bitcoin will go up to 200K and their psychology will shift, right? It's all about the expectations. The people have to see that it's going to go up to 200K and believe it for them to hold on and keep on holding to push this further, and then people go back. But there's a lot of competition right now for the money. You see software now is moving up. So you're going to be in competition with the people that look at this, look at IGV and go like, yo, IGV finally broke above this blue line. Yes. So we just broke it today. Okay. So this has the same problem as Bitcoin, right? And MSTR. But are people more willing to believe that this will go back up here first, or will Bitcoin? So that's the competition, right? Yeah, that's the competition right now. I think these are the same type of traders and investors, people that love high growth names. The people that like crypto are the same people that like this software crap. They just like high growth multiples. Ooh. So all the earnings have to hit. So I saw something after hours on Palo Alto Networks. I think some analysts started trying to pump Palo Alto Networks. That's why you see IGV up today, because somebody was trying to pump after hours on Palo Alto Networks here, and then CrowdStrike followed. Okay, here. So we were talking about those two stocks last time. Those are probably the best performing ones. And then after that, we look at Oracle. Okay, Oracle, because now Oracle looks like it's about to break out. And Oracle doesn't have earnings until way later, right? Sometime in June. So once this goes, it probably can really fly. But so which one of these are going to be the winners? Is it Bitcoin crap, MSTR stuff, or is it this stuff? I don't know. I think it's the same type of people that play both. Or maybe those types of people don't want those things anymore. Maybe they're looking at HUT now and they're going like, shoot, maybe I should buy more HUT, because they'll buy the dip on HUT today. Definitely. HUT did really well yesterday. 30 something percent, right? 35. I think nearly 40% on pre-market during the taco trade. Pre-market. And what's the only competitor right now is like CIFR. IREN reports to after the close. So we have to look at IREN. That's the risk you take. If you buy these two dips now and IREN doesn't give you the result you want, that might just take everyone back down. Okay, before Friday, before a weekend too. So you might be taking a long shot and hope that IREN doesn't fail. Okay, yeah. But overall, IREN is up here. So this was during the taco trade, right up here. So that was a good time to sell some, because the last time it went up here, look what happened. It just came back down and it went back down below this. Will it happen again? Will this happen again? Only a few of these are going to be winners. That's why I picked HUT. I picked HUT because it had a better chart characteristic. Let me put back the indicators here. Okay. So it has more of a trend. Let's look at the weekly. Okay. It has a very strong trend, a trend that started in August of 2025. Compare that to IREN. Okay. This one, okay, started July 2025, around the same time as HUT. But look at that. It started failing immediately with this huge red bar here on earnings, I guess. We had earnings week, November 3rd, and then the second week after that, complete failure. So this started this long sideways. It's not even sideways. It's really ugly, right? It's so wide and sloppy. It looks disgusting. Look at HUT. Compare that with HUT. Goes up. We fail again, right? But it didn't go sideways. We immediately had this reaction here in Thanksgiving, and then we pushed higher, made a higher high than this, and then we had a range on top of the previous little peak up here, right? Now compare that again with IREN. Look at this. It just slid down. When we recovered, it just went kind of halfway on this red bar here, covering it up, and then 2 more weeks later, fail again. So that's why I'm not really bullish on this. Like, it has to prove itself. Hut already proved it to me. So if there was anything that I would have like said would go up the best, it's still Hut. Hut has the best looking chart. I have no idea about any of the fundamentals about Hut, IREN, CIFR. CIFR probably now that it performed so well this week after earnings, I think this will probably be second place now. So Hut, CIFR. So then these two might be the two that I'm focused on. IREN and Core Z probably going down the list. Maybe APLD. The way this is looking, APLD, if it breaks over here and holds, like it already tried to break it this week, but it's pulled back. If this thing holds $40 next week, then this is probably third place. So number 1 is Hut. Number 2, CIFR, or maybe number 2 is APLD. I haven't decided which one, but I'm not going to waste my time with all of these. I'm going to only focus on Hut. And then unless I get a clear idea of who's number 2, it's just Hut. That's it. All right, because Core Z failed. It tried to get up here yesterday, right? It pumped with the taco trade, pulled back. Now it's below here. That's it, guys. So if we look more closely at the 78 minutes, I think we're going to build a range here. It's a wide range here. All right, it looks like this, top to bottom. It will go sideways for a bit, and we'll have to wait a while and figure out if this is worth looking at any further, because I think IREN or APLD or CIFR will be the number 2 guy here, and that will be it. These three, one of these three will be my pick, and then Hut, and then I'm only going to do 2 stocks from now on. Hut and one of those 3. That's it. Okay, and I think IREN is basically a replacement for CoreWeave. I think they kind of try to do the same thing. So let's look at CoreWeave. CoreWeave is another one. Okay, but this one is very tied to OpenAI, and you can see this one is a lot uglier and it also has less history as well. Okay, you see that? It's not even at the top yet. We still have 183, and this was made back in June of 2025. And you can see, like, yeah, it looks a lot uglier. So I don't know. It's going to depend on OpenAI. A lot of OpenAI rumors. And there's a lot of rumors swirling around about OpenAI. They could easily take this down if somebody reports that OpenAI hasn't met its milestone, Microsoft isn't paying OpenAI as much money as they used to. Because right now, OpenAI has a contract with Microsoft. OpenAI has to meet certain goals. Okay, if they don't meet those goals, Microsoft is not obligated to pay them any more money. They're supposed to be paid billions of dollars by Microsoft. But by the time they IPO, if Microsoft only paid like a few hundred millions, that might be a bearish sign. And people will take advantage of that and put a lot of quote unquote news, right? Rumors in circulation to push the price back down. So that's kind of like the thing you got to worry about if you use CoreWeave, CRWV. So I don't know. You have to consider all these possibilities. Everything is potential right here. But Hut is still looking good. You see that? The bottom today isn't much lower than the bottom it made yesterday. So this range is holding right now. And you have this nice gap. So once you make this gap and you hold the gap, it's building energy to continue on up. It's going to build energy. It's going to zigzag. Hopefully IREN doesn't spoil the party. If IREN is bad and it takes everyone down tomorrow, then we're going to revisit 83, which sucks, because then this range will expand over here. Okay, and that means it's going to go zigzag a lot longer. If it's a tighter range, it won't spend much time doing this before going up to the next level. All right, the wider the range, the longer it takes to chill. Okay, you kind of look at this. Look at this. So I drew this today for a reason, to illustrate for you guys that, can you see the higher highs here that become lower highs, and then you have this flat bottom here. People are buying at the same level, okay? And then this keeps decreasing. So the range is creating an apex, okay? It's creating an apex. When it creates this apex, that means volatility is decreasing. And you could see, like, by the end of March, it dipped over here, but it wasn't a strong push down compared to, let's say, IREN. Let's look at IREN. What did IREN do? Look at that. Look at IREN during the same time. A lot stronger, violent move down. It was easy for people to panic sell here. See that? Compare that to HUT. Look at that. It's much tighter, less panic. That means people were holding. Anybody that was panicking here were stupid because you missed all this. All right. So that's it. That's psychology. That's all psychology right there. So if you look at the spreads between all these little candles, you can kind of see pictures, and these pictures will help you determine what's the future. That's it. It doesn't guarantee that the future will look good, but when I compare HUT to all the other similar AI, Bitcoin, crypto type stocks, this one was the best looking one. The picture just looked better. And there's a higher probability it will act and behave better once we break out. And looks like that's true. That's true. It's been proven correct. And if you look at CIFR, it also had a nice, calm looking shape. So if I look at the daily chart, you see this? The range is decreasing. The range is decreasing. And now it popped. Does it mean like it's going to break out very well? Well, I don't know. It's not as clean as HUT though, right? HUT had a very nice movement up here because when HUT got out of last April, it continued on up after October. You see, like this, and then it moved up again into January. HUT was the only one I held from April. I had a bunch of these little positions on these stocks, but HUT was the only one I held, and I added more because it looked the strongest, and it still looks the strongest. And so I cannot take away HUT from number one position right now. HUT, it looks like it. And maybe it's because Trump's son is in it. I don't know. Whatever the reason, HUT outperforms the other ones. And if you just look at the chart, it's very clear. Just put everything up and compare all of them. You'll see, right? You'll see very clearly this one still looks good. It looks impressively good right now. So, yeah. So we'll have to wait for IREN tomorrow. Let's see how these little ranges. So I drew these little like ranges here, and we're gonna have to see what kind of range they make. So let's look at APLD. I think if it zigzags here a little bit, that'll be good. It should be easy to push this up higher. We already broke out of the high here, 2025 October, and then it hit here January, and we hit here once again. Once this thing gets going, it should be pretty good, because I think you can consider this whole thing a range. All right. So maybe this is done and we can go a lot higher on APLD. If that's the case, this is number 2 then. HUT and APLD are the winners. I don't know. I'll have to wait for CIFR if this one wants to break 25 next week. If it doesn't, then this will just be a fail. This thing will just crash below here and fall all the way back down to 13. Okay, not all of these are going to win. Only a few of them are going to win now. Okay, that's it. Because this is the beginning of the next level bubble. Everybody here is competing with each other for the same sectors, the same AI money. Not everybody's going to win this game. So we have to stick with the leaders and throw away the losers. Any losers you see, do not hold them. All right? So that's the Druckenmiller way. That's a George Soros way. This is why I only have a few stocks that I hold for trading. All right? I don't diversify. If I see a winning sector like oil, I'm putting all my energy and money into focusing on oil, right? And then once oil is done, then I go somewhere else, right? Let's look at software. Let's look at this AI hyperscaler build out stuff. That's it. I'm still quite shocked that people still ran into semiconductors. It's ridiculous. Dude, bro, I was in semiconductors over here and I pretty much said like we're done in February, man, before all that whole Iran stuff started kicking off. And then after it made this low, it just zoomed back up. It's just like, dude, bro, you can't just keep going back to one sector. You just can't. The stock market cannot just be one sector, man. It's like nobody wants to buy any other stock except semiconductors now. You guys are retarded. You guys are retarded. That always ends badly. That always ends badly. All the money here is going to come out and go somewhere else. Yeah, eventually. You just have to know what time, though. That's the problem. But if you look carefully, this gap is very good, right? You have a gap, you hold the gap, and then you start flying. Okay? If you look at HUT, you want to see the same thing. Okay? You see a gap, and then you want to hold the gap, and you continue flying. That's what you want to see. All right? So we're waiting. We're waiting. All right, guys. Okay, let's look at gold a little bit. So I said last time probably like Wednesday would be the temporary bottom for gold and it would bounce. Looks like it's true. Yeah, it bounced the last couple days on that last taco. But look at today, it fell back. So I don't think gold is going to make a new trend. So it's going to go sideways. And as we know with oil is also going sideways. Remember I drew this channel here? Look at that. It went below this channel, it went above this channel, and now we're right back to the bottom of this channel. So we're just going to keep going zigzag, 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 all the way into August, July, August at least. Okay? So I wouldn't be caring about looking at oil until August, July, August, maybe even September. This stuff might be so boring. Like, I mean, you could trade it, but look how challenging it is to trade gold. I don't like sideways stuff. It's just like it's too hard. Especially something that's tied to a commodity. So something that tied to gold, silver, oil, that's good luck figuring out when the turns are. And you can see how highly manipulated they play the game over there. Okay, that's the boomer crypto is trading commodities. Anybody that trades commodities, currencies, okay, FX, those guys that's the crypto of the boomer world. Okay, so there's a lot of money traded in futures, and they think they know when the bottom and top is for that stuff. I don't like that. I don't like that at all. I like this when you have a trend. You see, you want a trend. This is not a trend. This ain't a trend. So until it makes a new trend, like it breaks out and goes up again, or it breaks down and goes all the way back down, that's a trend going down or up, then I'll play gold again, right? But otherwise, I ain't playing this. Forget that shit. There's a lot of better things to play. Let's go to HUT. This is good. This looks good. This is a trend. It looks like it's about to be a trend, so go for that. There's a lot of fish in the sea. You don't need to go to something that's hard to trade. Why do you need to make your life hard? Make your life easy and do something that makes you money without you worrying the next morning some guy pumps out an article or Trump tacos or something. I don't give a shit. Really unimportant. Okay, let's see. Let's look at your feel like if you call anything, you'll jinx it. Yeah, most people feel like that. It's your own behavior screwing you up, right? Like you get too greedy, you think it's going to follow a certain way, it doesn't follow it. That's one problem. That's why most of this whole game is all about psychology for you and the psychology of other people, the crowd. There's crowd psychology, there's your psychology. And outside of psychology, we have to introduce new variables like the options market. The options market is pushing this thing mechanically up. And I am going to play a presentation for you that I screen recorded yesterday. Okay, so I'm gonna play that for you guys in a short while here. Gold has been on a roll. If it continues this month, it might just make a cycles believer out of me. Yeah, you might. That's it. Okay. Overnight traders took. Yeah, that's the problem with that one, huh? CIFR, you could get in without that because CIFR, when it opened, it was like flat. It was flat to down. It was pre-market, it was up. Then by the time it opened, it was flat to, and then it was starting to go down, and then it zoomed up. HUT, it didn't give you a chance. Once that Trump Taco article pushed out for 3 to 4 hours before the market opened, the market was crazy high already. And then once HUT released its earnings, it went even higher, right? First, HUT was like up 15%. Then the earnings came out plus another 15%, pretty much 15 to 20. The year done. It was like 35 to 40% already by the time anybody could do anything, really. Note to self: never. Yeah. It's if you look at semiconductors and you think like you buy the pump, it'll pump again. That's rare. That's rare. Okay, so it's something's wrong with the semiconductor side of things. Like the people go to Korea, it gets pumped. Korea gets pumped, and then after the Korea markets get pumped, then the U.S. markets get pumped. So there's a back and forth between Korea and the U.S. right now, markets. So somebody is just gassing up Korea overnight, then it's used to gas up like the US markets during the day over here, and then we go back and forth. Somebody's playing a game over between the two markets right now. So that's probably explains the semiconductor stuff. I think I got in on Tuesday, pumped yesterday, still in for now. Yeah, that's fine. If you're still in it, that's fine. That's why I said no leverage. Okay, because if you're doing leverage with this, you were up 60%. Then you would probably be saying, well, I'm up 60%, I better sell something. So you have to be very conditioned and think, okay, if I want to hold it, maybe I sell all my leverage and then wait for, or maybe a lot of my leverage, keep a small position, and then when it dips, I can buy back the leverage, or I just switch it to like the normal shares if I'm unsure, something like that. But I don't know how you would do that. Most people would just have options and learn options to figure out how to manage the risk over here, right? They could buy shares, it goes up, then they sell calls to protect from a downside. Then they cover their calls, and then they go and buy shares again with the money you made. You know what I mean? Like, I don't know. You could do all kinds of stuff with options. Like leverage ETFs are kind of lame in that sense. You don't you can't be very specific. Options has more specificity, but you have to know the mathematics behind it. Okay. Let's see. Anything else here? Think it. Yeah. Okay. Read that. Everything I had was down except gold, NetG. Yeah, because it pumped too hard yesterday. That's why it was just like a matter of time before it had to give it back. I think I don't know if it's going to trend those. We might be done with semiconductor short. It might just go back up tomorrow. I see after seconds use had a fast day, the crowd moved to software. Yeah, you noticed that, didn't you? It's been doing that since last Friday. You could tell like there was slow improvements in some of the stocks there. Of course, like we already have some earnings that sucked bad, like Fastly. Okay, this one this one's down 38%. Yeah, software, this is why people like software. They think like if you have a good earnings, you can go up like 80%, like right here, right? Oh, last earnings Fastly was up 60 to 80%. Now it's down 38 to 40%. Good job. People are addicted to the crack of software. They think like they can move fast. Like, look at this. This one reports after the close today. Where's this one gonna go? Where's this one gonna go? It's like, dude, what the hell? 120 down to 90, back to 120. Dude, I'm not playing this. I don't want to play this. Give me a trend. Give me a trend. If it's a trend, I'll play. If there's no trend, I don't play. So let's look at the long-term chart here. There's no trend. Why would I touch this thing? This is disgusting. This is disgusting. The volatility is so high over here. Like, if you bought here and you just hold it because you think one day it will get above 120 and break out, good luck. But if you're buying up here, you are just gambling. This is insane. These are insane moves, right? And we're gonna have earnings after the close. Whoa, man. This is either gonna break out and we're gonna shoot up 40%, like Doc N, right? Like this. Like, this is what they're hoping for. They're hoping for, like, if they can hold and it breaks out of the top, it can shoot up. Okay, go for it. But we'll see. We'll see if this is the beginning of something new. Okay. What else? D-Dog. Yeah, D-Dog reported earnings. Same thing. This was good. See? After earnings, 32%. See, this is why people like these stocks. They just want these crazy pumps and dumps. But I hate these. I want a trend. I don't want this. This is just for people that just want to gamble on earnings. Like, this is terrible. I don't know. As an investor, I do not like Warren Buffett would never buy something like this for sure, right? He would look at this, he would say, "Whoa, look at the volatility. The risk, because of this volatility, the risk is very high for the reward," and he would not touch it. There's something called a Sharpe ratio. So it would like look at the beta and alpha of or something like that. I think it's a beta, right? It looks at the beta of a stock. The beta meaning like what's the volatility, average volatility, and you can look at the average true range. We talked about this when I first talked in the show, when I first talked about like risk reward and that. So that's one way you could just measure a stock and go like, I'll never touch this stock ever. But if you're a gambler, this is perfect stock for you. All right, MongoDB, same thing. Look at this. This is nasty looking thing. It's up today after earnings, but look, I don't see any trend being built here. I don't see any structure being built here. I can't tell if this is gonna actually go up and break out, right? This has no, like, if you just look at this plain chart, this has no pattern that I can recognize. I can't tell if I should be bullish or bearish on this thing. It has no hidden message for me, so I wouldn't touch it. All right, let's look at the optical one. See, this is good. This is a trend, right? You go here, you build a range, and then you break out. Perfect. Good. This is what you want to see. I don't know what the heck you would do with this information. This has no information. This looks like a slop mess. So I think you could tell the difference, right, between something you want to trade and something you just want to avoid. But that's just my opinion. Your mileage can vary. If you like to play earnings, go for it. Those are the stocks you want to have. All right, let's put this back up. So you remember last week I said Teradyne, right? Someone asked me about Teradyne, and I said, okay, it's down on earnings. I think it's just going to go up here to the halfway point because now we know the top and we know the bottom. This creates a range. We're going to have a range now. What I think is that it's going to go halfway up here and then it'll go down. If semiconductors wants to break down, then we are going lower. This thing is just going to go lower and lower and lower and lower. Maybe. If this is strong, it will hold 300, 305, and it'll go back up to the halfway point, and then it'll dance here. Maybe it'll continue on up, or maybe it'll fail and come back down, and then we have to keep waiting. This range looks pretty big, so I'm going to assume that this will take all the way into October to finish. Okay? All right. So this will take forever in this sideways motion before we continue up or we just break down completely. So if you're looking to buy, you got to wait. This trend is broken now. See this trend from here, from last April, it's over. All right, let's look at air. What about this one? Still looks good. This looks good. It's just dancing up here. This is way better than Teradyne. So if semiconductors doesn't break, then I will say this will go up a lot higher into next year. Okay, so let's say it has a tighter range, it keeps doing this zigzag, and then by next year when it breaks out, this thing can be like a $3,000 stock or whatever. No, I'm just joking. I don't know. If we have a .com Tom Lee type market, sure, maybe $1,000 is next up. But for now, let's just assume we have to finish this range, and we'll come back to it. Okay, so this is what you're doing when you're looking for stocks. You look for it to have a trend, and then when it stops having a trend, you look at what kind of range it builds. If it's tight, if it's wide, all right, tighter is better. Am I right? You want something tighter. Who the heck wants something like a... Okay, I'm being disgusting right now. Never mind. I'm not saying anymore. Okay, so Micron. What's Micron? Okay, look at this bad boy. It's gonna have earnings late June, early July. It's gonna take a long time before we get to earnings. What is it gonna do in the meantime? If this thing starts dropping down, drifting down, yeah, we could be done with semiconductors, right? All right, look at SanDisk. Maybe that's gonna go away. Yeah, Western Digital. Maybe that's gonna... This is the first time we got a big red candle right now. Look at all the other red candles. Not that big. This one's pretty big. If tomorrow it gets another red candle and it's even bigger, then semiconductors is over. I think it's done. And you can hold your SOX S. I think Martin Shkreli yesterday said he's going to short semiconductors now. So he's joining Michael Burry to short. So we'll see. Look at the candles here. Okay, so watch them. Right now, the only two stocks, major stocks is semiconductors that's going up is Qualcomm. I have no idea who's pumping Qualcomm again. I guess because they noticed that Micron and nobody else is going to go up, they decided to go to Qualcomm to help keep semiconductors from crashing even further. But looks like, yeah, if it follows through tomorrow, it's going to be bad for semiconductors. Bye-bye, semiconductors. Nice to know you. NVIDIA, they tried to pump the last 2 days, but it might fail again. See how ugly this looks? Like, look at this thing. This is so ugly. There's really no trend here right now that makes any sense. I don't even know what the range really is. Like, is the range between 184 to 165? Or is the range up here at 200 now? And I can't tell. I don't know what it's doing. Okay? I don't know what it's doing. All right. After the close, we have a big optical player. Well, it's not big, but it's the one that people like to gamble on, AAOI. It'll have earnings. So if this thing breaks and goes to 100, and then you see Coherent already had earnings yesterday and Lumentum 2 days ago, if all those three, so LITE, COHR, and AAOI, if all three of those start going down bad, and then you have Micron and all the memory go down bad, then I think people want to get out and go somewhere else. Where's that money going to go? Software, probably. So look at software. Over the weekend, we're going to have to see which ones we're going to buy more of. So Oracle I got, Adobe I got. Oh yeah, Net will report earnings today. So I don't know if Net is good, maybe I'll buy Net. I'm not in Net. Cloudflare. I mean, this thing looks good, but earnings might just reverse this whole thing right back down. You see, this is ugly. There's no trend. It looks like it was kind of about to build a range here. Like, this could have been a range, but then after that, it just completely collapsed, and we got this huge volatility. So this was a range built up in 2025. Then once 2026 started, it looks like it just completely failed. I don't know how to read this. Like, is this a range? Is this a range? Yeah, I don't know. Man, look at how horrible this was in the beginning of April too. It's like, what the hell's going on here? Very weird. Hard to tell. Yeah, this one's hard to tell. Anyhow, Yeah, app reported earnings. Yeah, okay, let me look at app. Look at app. I guess that's good. Yeah, maybe I'll buy it. I don't know. But yeah, this one looks okay. This one looks okay. Because this is a range here. Okay. Yeah, that's a range. This is a range. So the top here matches the bottom here. And then once it breaks out of this, you see this? So this used to be resistance right here from this point. And then we're just been touching it. Yeah, once it gets above 514. Yeah, okay. Yeah, this could be good too. Let's see next week. Yeah, maybe it's ready to go back to 700. All right. So that's like about a 50% up, right? And then if you use the leverage one, then it's 100% over there for that one. Okay. All right. That's it. Easy. Easy peasy. Let's see. If somebody's crap tomorrow, yeah. If somebody's crap, no, but wait. Look at IGV. Okay, look at this. Okay, wait. Okay, let's compare. We have to compare this. Okay, let me get out. Let's look at the weekly. Let's look at the weekly. Okay, let me get rid of all this. So, semiconductors, right? Let's look at semiconductors ratio. Let's look at semiconductors compared to the S&P 500. So, starting in April 6th, that was the big taco week, right? So far we've been outperforming everybody else in the S&P 500. Now let's look at IGV, right? Okay. This thing is still underperforming the S&P 500 since last October. So next week, or I don't know, maybe Friday will be it. I don't know why Friday software will do something amazing, but who knows? Maybe there's some news that will make software take everything out. If this ratio, IGV over SPY, if this thing takes out like 0.13, like gets above here, okay, that's a good sign. All right, that's a good sign. At the same time, you look at the semiconductors. If you see this thing start breaking down, it goes below 0.6 or something like that. So look at this ratio compared to the other ratios. So that we could just, since they have the same denominator, okay, if you know math, you can just do like IGV divided by SOXX. Okay, so I'm just comparing software versus semiconductors. Let's see if this thing gets above 0.21. All right, so we just take the two ETFs and divide them by each other and see if this one actually breaks out here. Let's see if this thing breaks the trend. Okay, I don't know when we're gonna see that, but let's see. Yeah, and then there's the other like ETFs too, like Sky, right? Sky, that's another one. Sky has some cloud stuff here. Sky looks a lot better. Yeah. Right, Sky. Yeah, Sky looks like it's ready to go. And Sky has Nutanix, it has DocN, it has IBM, it has, what the heck is P? P is, what is this one? Everpure. I have no idea what that is. And you got CoreWeave. I don't even know why it has Lumen stock in it. Okay, whatever. I guess that's cloud. I don't think so though. Akamai, yeah, we talked about that. Fastly, MongoDB, and Dell. Dell. Okay, Dell. Yeah. And then we have communications, right? So this one, all these guys have pretty much reported except for Cisco. If you look at ANET, not good. ANET reported 2 days ago. This don't look good. So I don't know what that means for Cisco. If ANET's not doing good, is Cisco gonna do good? Cisco will be another one that people might pay attention to next. I don't even know when earnings is for this. It should be coming up. Maybe it's next week. If it wasn't this week, it should be next week. I don't see a date here, so I don't think TradingView knows what day it is, but probably next week is going to be Cisco. That's the one we're going to be waiting for. And then net is after the close today, right? So we should be done. Yeah. Oh, I hit it. Okay, yeah, it should be there. And then let me look back at Cisco. Yeah, I was right. Next week. Yeah, Cisco will be next week. So net after the close today, next week's Cisco. And we're done. We'll be pretty much done with the major stocks in the FDN. If everything goes well with the FDN, then yeah, WebL will probably be ready to go up again. Okay, WebL might be ready. You could buy a WebL again. See, WebL is not really much higher than where it was back in April 21st. It's been stuck there. AIBU has some semiconductors. That's why AIBU went up further than WebL. But after that, it's not going to follow the IGV, right? IGV stocks, you're going to have to manually put in like, okay, Palantir leverage, Oracle leverage, AppLovin leverage, CrowdStrike leverage, Palo Alto Networks leverage. You get what I mean? And that's how you get the leverage there. Okay. Shaz. Okay, Shaz. This one, I could tell it has low volume. So this must be a very small micro cap company. Yeah. You could tell it has very low volume because you look at the way the candles are updated. You see that? Because people aren't trading it, and then you have these gaps that start popping up all over the place. Yeah. So only very recently is getting more volume here. All right. So, okay. Well, this one's in the trend already. So I don't know, but it doesn't have much history. So you're kind of gambling, right, on this one. Yeah, there's an AI stock that's going to report tomorrow, software stock, Sound. I used to play this one back here, 2025 and 2024. Like, so Sound reports tomorrow morning, I think. So 6 to 20, 7 to 20. Let's see, it went back to 6 pretty much. It's at 9 now. Is it going back to 20? I don't know. I stopped paying attention to this one. I just don't care about this one. But usually, yeah, once you get to like 6 or 7, you can ride it back up here. This is kind of the same thing with RX, right? These software AI type companies. This one does software for pharmaceuticals, AI software for so they can just test drugs with software instead of animals. But once this thing failed to stay in this level, look at it. It just went down. So I don't know. I can start paying attention to these little guys. Like, what is it? Nancy Pelosi bought one of them, Tempest AI, right? I don't think she's still in here, but look at it. It used to be 100. Now it's like 48. But look at how ugly it is. It's completely ugly. It's like, what the hell is this? But the stock you want to look at, it has a trend already. So see, this is nasty. You can't use a chart to figure this one out. This is disgusting. But yeah, Shaz is fine. It has a trend. This is a trend. Of course, this is like, it could be a bubble, but I don't know. It's still following a trend though, so that's at least good. If you're gonna ask me like when is the bubble gonna pop, I don't know. I'll have to look at the DeMark for you then. Okay, I'll go over and look at the DeMark for you then for this one. Okay, look at the DeMark. I think that's the only way to figure that one out. So I'll look at DeMark. Oh, another one to look at again. TMC. Okay, so yesterday it got a pump. I don't know why, but that got me interested again. So this thing has been in this nasty range between 5 and 10. So during the first shows in 2025, I recommended Palantir and I recommended this one, this penny stock. So this does undersea mining. So it mines for nickel, cobalt, whatever, under the sea. All right. So it's going to go and kill the little mermaid and mine the home and get the rocks. And so far, It's been in this long, nasty looking range, and I'm kind of been waiting to see if it's time to get back in this one too. If this one is ready to go, then let's fly, because last time it flew, it was a 10x, a 10 bagger here. Went from basically below $1 to $10, right? $8 to $10. So it was in a nasty range for many years when it first IPO'd, and it took a while before this thing blew up again. So this might take another year. I don't know. But maybe in October, when we get our last dip, maybe that'll be the final dip at 4, and then this thing will go back up again. So TMC right there. So if you're looking for penny stocks, that's one to look at. Oh, the hantavirus. Yeah, I know, but I don't think it's ready yet. I don't think it's ready yet for the hantavirus. The hantavirus has to get more serious, and then somebody is going to have to hype it up, and then we'll get something in the thing. So right there, huh? South African health authorities said they have identified the Andes strain of the hantavirus, which may be passed from person to person in 2 passengers who were on the cruise ship that has an outbreak of the rare infection. Damn, what a coincidence. Moderna and Korea University to co-develop hantavirus vaccine back in July of 2024. There we go. Yeah. Okay, let's see. What other can't tell if we can't tell yet. We have to wait for Iran yeah, we got to wait for Iran. Okay. Yeah, the chart looks good. Yep. Yeah, not much panic. Yeah, APLD could be my number 2 after HUT at this point. Dude, CrowdStrike, Core Weave. Yeah. Don't confuse the two. I always get confused with everything now. There's Cloudflare, CrowdStrike, Core Weave. They all starts with C's. It's getting really annoying. It's like change your names to start with some other letter of the alphabet. It's just like so insane. I can't keep up with everything. I'm just one guy, you know. Okay, so in and out. Yeah. Well, I want to stay with HUT. That's the only one I'm willing to stay in longer than anyone else. So I think you get that. I think you get that now, right? Okay. All right, let's play some video. Okay, we're done with this stuff here. Let's play some video. So I had to screen record this, and because they use Vimeo, the streaming sucked. So bear with me here. So let me get my disc, and we can play this. Oh my god. All right, let's get the disc out. Any other things I want to talk about? Let's see, what's this one? Okay, so I think the target for the S&P is still 750. So this is from yesterday. Maybe I'll talk about this once we're done with the video. Update it. So 750 for the SPY. Okay, that's still the target right now. We hit 734. This one's the QQQ, right? So I think we're done with the QQQ. Nasdaq is done. I think here. So I think it's once you see the semiconductors start pulling down, you'll know I was right. So I think semiconductors is done there. So the DeMark indicators pretty much says 750 for SPY, and the QQQ we're already there. We already hit it. So there's nothing left for QQQ. So that means we're going to start going sideways. So one thing will go up and the other thing will go down. So I'm hoping that means semiconductors goes down, software goes up, right? That's what I'm hoping for. And as for HUT and IREN and all that, we have to wait for the earnings and see how happy they are. They might get influenced by semiconductors going down, or they might not. So you might be able to get a better dip next week. So don't be in a rush to get it, especially if earnings is bad. Okay, guys, that's not good. Okay, so What's the other image? Let's see what this one is. Last one. What's this one? Okay, I think this is the ratio. So there's a ratio of high beta over low volatility. So you see this? This has broken out. This is way higher than the COVID bubble. And what this means is that high beta stocks, we talked a little bit about beta, right? Like software companies have very high beta because they're very volatile. They go up and down 20% in a week because of blah, blah, blah news or blah, blah, blah earnings. And that means it's high beta. So when the high beta stocks outperform low volatility means boring stocks, Warren Buffett type stocks like Coca-Cola, right? Mondelez, okay. What other one? Colgate, Palmolive, McDonald's, Walmart. Those are low volatility stocks. So when high beta starts outperforming low volatility, you know what that means? Bubble time. So we can get a nice fat bubble come next year if this ratio keeps going up. So we can make a lot of money real quick. So that's good. Because I know you guys don't want to be poor when we have hyperinflation or stagflation or whatever the heck's coming down in 3 years. Something bad is happening in 3 years. So you better grab the money. Imagine it like that game where they have the dollars flying around, and you're put in that little glass cupboard, and then they have the they would have this in casinos, right? In a casino, like if you win the slot machines, and then you can just jump in those things, and then they'll make the dollars fly around, and then you have to catch as many dollars as possible. Or the lottery, they'll do that too. If it's like, I don't know, state lottery, they'll have that. Yeah, that's fun. That's always fun. All right, guys. Okay. Actually, let me play this first. Let me play this one first. Okay, then we'll get to the heart.
Our thinking inside out, because people say, well, it's too expensive to buy it here. And that's absolutely not the case, because this is the beginning of it. We're in the second or third inning of this. People have a very difficult time with that. What people want to do, though, is they immediately want to psychologically get the self-gratification. In fact, Breckenmiller tells that very story in this interview. It's a great story about NVIDIA. He'd made a huge gain on it, and he's a big trend trader.
Yep.
And he goes, it was like at $800. NVIDIA was at $800. And so he sold a big part of his position. And he was so proud of himself. He tells the story. He's so humble. I love the guy. And within a few weeks, there was at 1,500. He's been in the business forever. And it was painful,
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're sitting down with educator and Wyckoff expert Bruce Frazier. I met Bruce a number of years ago at a conference. Pretty sure it was down in New Orleans, actually, and we headed off as we were walking to dinner, and it has led me to a number of fantastic conversations with Bruce over the years. He is just genuinely one of the most warm and approachable and thoughtful market practitioners that I have ever had the chance to overlap with. Today, we're going to unpack sort of the idea of Wyckoff analysis. We'll talk a little bit about Richard Wyckoff and his methodology. We'll talk about how we can use the labeling practice that Wyckoff pioneered to define the structure of the market, and how the current market environment fits actually very nicely into the structures that Wyckoff created and popularized many, many decades ago. All along the way, you're going to hear some pretty awesome quotes about market analysis and decision-making, and some great market insights as well. So please enjoy this conversation with educator and Wyckoff expert, Bruce Frazier. I am super excited to be sitting down with the person who I would argue one of just the nicest people in the industry that I've ever met, Bruce Frazier. Bruce has been in the industry for about 45 years. He spent 30 plus years as an educator, teaching technical analysis, teaching the Wyckoff method, which he still does to this day. I've learned a ton, and I would say some of my favorite experiences, Bruce, of attending a number of conferences over the years, is on that off chance that you and I sit near each other during dinner, because I know we're going to laugh a ton and enjoy it. So it's great to see you here today. Welcome.
Thank you, David. When you invited me to come on, I was so excited. I love to hang with David. It's fun. If we can't sit at dinner, we'll do this.
Yes, that's right. Standing invitation that we'll get together at some point, Bruce. But for now, this will have to do for all the viewers and the listeners. So
Wonderful.
listen, as I mentioned before we got started, we do a market recap show, and often I will get comments and questions from viewers mentioning the Wyckoff method, that this is a certain Wyckoff pattern or season or setup. So I know that a number of the people that follow my work understand at least something enough about Wyckoff to know that it's something they probably want to know more about. So I hope we can help kind of set the groundwork for some of those people, and especially those that aren't familiar, to kind of know what they'd be getting into if you start looking at things through we call a Wyckoff-ian lens, I guess. For people unfamiliar with what the Wyckoff method is, or Wyckoff in general, how would you explain just the core idea or premise of that in plain English for people that are unfamiliar?
David, why don't you ask me an easy question?
And you have 5 seconds.
Wyckoff is visual. It's very visual, but it's very contextual. And there's a reason for everything that happens in a price chart in the Wyckoff method. And this method goes back to Richard D. Wyckoff, whose career spanned from the late 19th century through his death in 1934. And he wrote a course. It was a correspondence course, which was how things got done in that era. And he wrote it when he was recovering from illness, and it's brilliant work. And the thing about Wyckoff is the Wyckoff wanted to be able to explain everything that was going on the chart. And so there's reasons for everything that happens. There's the reasons why you get big markdowns, climactic conclusions to those markdowns, and then you build a cause, which may be a cause for another markdown, or it might be a cause of accumulation. And the thing that we would always do in the class, and Hank and I taught this class for 27 years, is that you're always dealing with the narrative of the different informed interests that are in the market. And so we characterize them, and they're heuristics. There's the public, who are the weak holders of stocks. And then there's the institutions, and then there's the composite operator, we would call them, which were the very best institution. Typically they're institutions, but they're the very, very best. They are the way out on the edge of the distribution curve. And there's a lot of institutions that are just, kind of in the middle of the curve. It's where they want to be. And there's some that are just exceptional. And they're not all technicians. You look at somebody like Warren Buffett, who very clearly is a composite operator. Obviously, as we all know, he's way out there on the curve. But what we're doing is we are telling the story of the smart money, the composite operator types, through the action of these structures that are occurring, because stock needs to be in strong hands to go up. There's the essence of it, is that stock needs to be accumulated, absorbed in strong hands. And these strong hands are very knowledgeable. They know what they're doing. They know why they're doing it. For instance, one of my favorite CO types is Stanley Druckenmiller. And he just did a really good interview with Morgan Stanley. And it's on YouTube and you can watch it, but listen to how he talks about, say, buying NVIDIA. He's a very chart-centric visual person, and he's a trader-centric person, but he has all the skill sets. And so we find those people and we evaluate them, and we try to build their abilities and belief systems into our own nature. So in Wyckoff, and we did a lot of this in San Francisco, is we literally set up groups where we learned how to be able to study the behaviors of the best investors of the era. And so, for instance, we studied the market wizards, and we would get the market wizards to come out and talk to us. and so on. And we would model their mindsets. So I'm always interested in that. But that's a very Wyckofian thing, because what we're doing is that we're modeling the mindset of these CO types. We're watching their behavior on the charts. We're watching it in the relationships of spread and volume from one bar to the next to the next. And this is what we would teach. And then we'd put it all together in the context of the whole structure. Now, it sounds a little esoteric here, but it happens this way over and over and over. So I've written a number of blogs on this. We use schematics. And these schematics, no two charts are alike. No two setups are completely alike, but they have family resemblance. And you can see, right? You can see the characteristics of the weak holders, which are literally just giving up their stock into the final lows of the market. And the support on the chart is set by the large informed interests that have decided. Support, by definition in Wyckoff, is the value zone. This is the place where the large interests have said, this is where I want to start to accumulate this position. And there's a saying on Wall Street, and we don't try to buy the lowest price, believe me, but it tells you a lot about the way COs think. Because what do we know about COs? You know a lot of COs, David.
Mm-hmm.
You know, I should be picking your brain. Why the hell are you interviewing me? And so these are the people, they know what they're buying, they know why they're buying it, and they have such a big portfolio that it takes them a long time to do it. Think about how long it takes a Warren Buffett to be able to build a meaningful position in a stock that he wants to own.
Yeah.
And when he builds that position, the only thing that's going to get him to sell that position, and this is the part about absorption, accumulation absorption, is that the only thing that's going to get these big, large, informed holders to give up their position is much higher prices. And that could take years, right? This is one of Wyckoff's laws, which is the law of supply and demand. So when there's a huge amount of supply out there and stock's not in strong hands, prices are going to fall. There's no support for that stock. There's no sponsorship for it, and down it goes. But it's going to get to a price zone sometimes, not all stocks do this, where it becomes very valuable at a price, because this is an auction market. These people step in, they start accumulating shares, and when the supply gets all absorbed through the course of that accumulation structure, then the only thing that could happen is the tiniest incremental increase in demand, supply and demand. Supply gets absorbed, tiny increase in demand, that stock is going to start marking up easily, right? And it's not going to take a lot of volume to do it. I don't think there's anybody that explains volume better than Wyckoff.
There's so many awesome points that you hit in there, and a number of great quotes. I scrambled to write down as many as I could, but stocks need to be in strong hands to go up. That's my new favorite quote. I love that one. That's a good one. No two charts are alike, but they have a family resemblance. That's a keeper too. We'll keep both of those. It's so funny. You mentioned, the larger institutions and how long it takes them to accumulate and distribute, right, positions. And that, in my experience working for large money managers, it was really fun to have a lot of zeros in a fund you're working with, but it also was the most restrictive, painful thing, because you were the Titanic just slowly kind of nudging one way or the other.
Right? I mean, great institutions trade the way they do because they have to.
Yeah. Oh, yeah. We spend most of our time dealing with the constraints of the size of the funds and less enjoying the great benefits of the size. It was more painful than anything. And
all right, let me comment a little bit here. You remember one time or maybe two times I mentioned this. When you're a big institutional player, okay, and you work for a big firm, they have rules. And one common rule or rule of thumb is that they restrict how much you can go to cash. All right. Most of the time, you can't go below 20% cash, meaning like short-term bonds or just cash. You got to be exposed. You got to be always exposed. So even if the stock market is going down like crazy, you can't go more than 20% cash. You have to hold. So that's what he's talking about by restrictions. There's a lot of restrictions with big money. Okay. So you're not going to have like some crazy panic where all of a sudden the US stock market goes to zero. All right. The system is designed to have some kind of level where it's going to stop. All right. So there are circuit breakers. There's all these big institutional funds that are required to always be exposed to the stock market. So even if the stock market is going down, they're still buying. They're still buying something. They have to buy it all the way down, even if they don't like it. Because if they're selling one piece of the sector, like let's say there's a big technology crash. Well, if I sell 100,000 Apple shares, I have to buy an equivalent amount of money somewhere else because now my portfolio is starting to increase in percentage of cash. Then I have to move somewhere else. So maybe I'll buy some oil stocks, right, with that money. So that's why you always see this rotation. Always this rotation. You'll never see it where all of a sudden the market just goes to zero. That will never happen. The market is designed to go up. This is why the US stock market is such an amazing thing to have. You guys are lucky to have access to this market. You know, there's people in the UK, the EU, and Australia, New Zealand, Canada. They have to go through a bunch of hoops just to get access to our markets. Our casino is designed over time to go up for a reason. All right. Okay, let's see. Yeah, you know what? We're going to have to talk about this sometime, huh? Because AI is getting really good. I know Ava's using Claude. So I'm hearing good things about Claude. So maybe I'm going to have to make an account, see what's up. Maybe I'll have to actually buy a subscription. And yeah, we'll see. So, you know what? I'm going to have to go over a book. So the book that Lars von Tienen, who makes the software for us to do the cycle research, he wrote a book like many years ago, okay, which is the basis of what he's doing right now. All right, that has something to do with cycles. So maybe it's good time to start going over it. I haven't read it myself. I just haven't had the time to. But I mean, because you are an electrical engineer, I'm guessing, so you might find a lot of interest in that book. Okay, because he comes from it from an engineering point of view. So there's going to be a lot of math, fast Fourier transforms, blah 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 blah, filters, you know. So you probably will find it interesting.
In my experience, right?
Your experience and your knowledge about that is
Oh, okay. I forgot. We got two more comments here. This is a question that's complex. Maybe I will have to go back to my old videos and try to find where I talk about this particular topics, because I've talked about it before and I don't talk about it much anymore. It's kind of like a personal thing, right? Sometimes people depending on their psychology or where they're at in the trading game, will decide different ways. That's more of a personal thing. Yeah, right. Since I'm getting older, I'm not going to take much risk, obviously. If you're younger, you're going to take more risk. And how do you measure risk? And I mentioned Sharpe ratio today, and there's other ways of measuring risk, but yeah, Sharpe ratio is one of them. So maybe we'll have to talk about it again. But I don't know. That's an old school way of looking at things. Maybe it doesn't apply anymore. I kind of feel like if I start talking about all these old concepts that people have used to trade and invest, when we're going and moving to the point where we have very volatile markets and things, forget about risk. Just go all in on HUT. Just go all in on SOXL, right? I mean, that's what I did in April. It worked for SOXL last April. And I was kind of too scared to go all in SOXL again this April, right? But If I did another SOX L trade this year on April, then I would have got a lot more money. But because I looked at it like, dude, the risk reward doesn't look good, I don't want to do that again, then I missed out. So if you look at those old concepts, you look at Sharpe ratio, you look at other things where they talk about like, oh, don't play with something that has a high beta of this level and magnitude. It's just like you miss out on so much money. So I don't even know if that's the right way to look at things. You got to be adaptable, to be honest. You got to adapt to the situation and conditions of the market. Ava, yeah, just considers diets. So she tells Claude, make her a diet, make her a workout routine, stuff that, yeah, that's it. For me, when I do something like within 2 days, 3 days, I'm just going to use 5 to 10,000 with just straight stock, right? Or maybe with leverage. And then if I do something that lasts for a quarter, 3 months, basically 1 month to 3 months, maybe I'll up it up to like higher, but it depends on the market conditions. Yeah, it really depends on the market conditions. So last year when we had that big drop on the tariff stuff, I just dumped like pretty much nearly 100K into a SOX L, into one position. It was just too obvious. It was like no brainer. Like I know everything is going to go up, okay? Because you already had like a 13, 15% to 20% correction. You had the Zweig breath thrust trigger late April. You had a lot of momentum starting through May. So I went from like 50K to 100K, and then like just held that sucker all the way into like freaking September through October. I started selling some, and then I hold whatever was left over into January, February, and I sold the rest. And then I just went to oil with that money. So, but that's only because you had a very good dip, right? And it had all the indications that we were going to have a 20% run in the S&P 500. So I was just lucky that I picked the right sector. Okay, I could have just like did that, jumped into gold and silver, jumped back out with that money, zigzag, but I didn't need to really. Yeah, I think just staying with semiconductors was good enough. I didn't want to, but if we didn't have that kind of a dip, we didn't have that kind of a dip this April, so I didn't do it, right? We didn't have a clean flush of the markets. So when we had that little correction going into the end of March and we bounced out of it, okay, software zigzagged a little bit before it got going. Semiconductors was more clean. And then once we got the taco 1 week after, then semiconductors was the one that really just lit up. Like software kind of followed it for a little while and then tapped out, right? Software just tapped out. And then everything else was just waiting on earnings, like the communications, and semiconductors was the only one that just kept on going and going and going and going. It just was endless, relentless. And that's just something that never happens all the time, right? That's something you couldn't predict, really. You're just like, what? So that's rare. So if I'm going to bet a lot of money on something that's so rare to happen, I ain't doing it. Right. So that also has to be taken into account. Yeah.
Priceless.
You're kind to say that. You're kind to say that.
Well, it's true. It's very true.
So tell me this. And so one of the things that I've learned having, listened to you and Raman Bogomazov, who I know you've worked with closely for a number of years at Wyckoff Analytics. When I hear either of you present, I'm always struck by the labels that you assign. When you bring up a chart, it's labeling a markup phase, these different periods. And can you talk a little bit about those labels? You mentioned a number of them during different periods. Why is that labeling so meaningful? And is it something that I guess ties it to this larger structure, this way that
because okay, one, leverage funds are great when you have a trend. If you have a nice trend, look at SOX L. Look at that. It's a nice trend, right? If you have a trend, you don't have to worry about that. If it zigzags, yeah, you have to worry about that. If it doesn't zigzag, I don't care. Number two, I'm lazy. I don't want to learn options. I just have a lot of money, so I can just buy a lot of shares if I just want like a lot of leverage. I just don't care. So, I mean, to me, it's like options has two purposes. One purpose is to give you insurance for shares you own. Number two, to create leverage for you, or number three, to create some kind of crazy trade where you're going like, I bet against volatility, so then I create an options trade to bet against volatility, or I create an options trade to do something for earnings. Or I don't do that stuff though, so then that's why I don't do it. I'm playing with much smaller totals, yeah, and that's why a lot of people go to options too, right? You don't need a lot of money to make a lot of money with options, so you don't need a lot of capital. I mean, if you have a lot of capital already, then you probably don't care about doing it. But if you have very little capital, then but if you have a trend, there's no problem with leverage ETFs. And actually, leverage ETFs will outperform when you have a very strong trend, right? Like if you did SOXL and it went in a straight line up, which it did, right? And pretty much like from last April, we went from from $8 all the way to freaking 80, like SOXL, pretty much in a straight line as well. Not very straight, but pretty straight. So then you get like you don't care about that rebalancing stuff. But if it's a zigzag range, no, you have to get in and get out, get in and get out, get in and get out. Yeah, because you can't. Otherwise, you get chopped to death. Yeah.
Do different charts have a family resemblance?
Everything in the Wyckoff world is contextual. Everything follows an order. If there is stocks in weak hands and it's on its way to going to strong hands, there's certain things that have to take place in that stock for that to happen. We're like trackers, and being trackers, we're out there, we're following the herd. We can see where they're going. We know what their tendencies are. This is the same thing with the CO. The CO is so big that they can't hide their tracks, but they do everything they can to muddle them up. They don't want anybody to know what they're doing, because lesser institutions will start to compete with them for available shares of stock supply that they're trying to absorb. They don't want any competition, and they don't care about the public. What they care about are other institutions. So when you complete, now this is a long way, I'm sorry I'm going around the block to get there, but when you think about the context of an accumulation structure, we look at it as phases. And we basically start with phase A, which is the stopping of a downtrend. Phase B is stock is still in weak hands, but there's a floor under the stock, which is established by the composite operators. That is their definition of the value zone. So they're going to be willing to buy stock along that value zone, and they are very patient about waiting for that. So they will wait and they will buy stock at the bottom. And in the olden days, I don't know about now, but in the olden days, they would supply the market with some stock to check the advance and keep it in a trading range. Because if there's still a lot of supply, you still have lesser institutions in the public that wants to get rid of their stock. And interestingly, when you get all the way through the basing structure, so you have phase A, which is stopping the decline. Phase B is building a cause, which is this big volatile trading range where support is evident, but also supply comes in at the top of the range. And then you have the final phase C, which is the final testing phase of accumulation. That is where most of the absorptions occurred. And it's the beginning. Phase C is the beginning, the last test in the beginning of markup, but it's still in the trading range. And phase D is the markup to the top of the trading range. Phase E is the new uptrend once you get out. And you can see that every phase has a different price volume characteristic. But here's the part that I find so interesting, David, is that the public, when you get to the ending of the accumulation, they become so worn out by the stock not going anywhere that they may have bought it at the top and held it all the way down. And the last of them, and it may be the public, it may be institutions, but they finally just go, I can't stand it anymore. I got to get out of this thing. I can tell you countless stories about people giving up their stock as phase C goes to phase D and the new uptrend's about to begin. And so it's every aspect of this is very psychological.
And that gets me to, I think, what I would argue is one of the best parts of the Wyckoff method. I love the, this cause effect sort of relationship that you've mentioned a number of times makes a ton of sense. The idea that there's these different phases and thinking of technical indicators as a way of kind of categorizing where we're at within this larger structure. Can you talk a little bit more about the behavioral and psychological implications of the Wyckoff method? Because I think that, for me, I mean, the podcast is called Market Misbehavior, and that was an intentional choice of recognizing the fact that so many investors just make bonehead mistakes and make poor, it's poor decision-making more than anything. What are kind of the behavioral or psychological implications of a Wyckoff structure? And if you could extend that analogy, what does it tell you about the current market environment with so many kind of growth-oriented stocks feeling very extended? How does that fit into this structure as well?
Sure. And think back to Druckenmiller's great interview, which I so encourage people to watch it. But he says, contrary opinion is really overweighted. It's like, once you get into a trend, the majority is right. Once you come out of the accumulation structure and you start marking up, that's where all the fun is. I find the accumulation structures interesting. And there's a whole other aspect of accumulation and distribution. And we have another sub area called reaccumulation, which is these pauses on the way up. And redistribution, which are the pauses on the way down. Those are very valuable. And those have a lot of the characteristics we just talked about, phases, and so on. But the thing about accumulation when it turns to markup is that for most traders, it's very psychological that they have a really hard time paying for strength. And this is one of the things that we psychologically really work on in Wyckoff is that, a stock that was at $30 at the support level, and then it gets out of the trading range and it's at 60. It's like, well, I can't buy it now. And, with Wyckoff, because we were looking at the context of the situation, we're going, this thing just moved very easily up and out of a resistance area that's been in place for a year and a half. And it did it. And now it doesn't even want to pull back. It just goes, if it stops out of the accumulation area, it just goes sideways. And it's just it starts to really leap. And in Wyckoff, we need to turn our thinking inside out because people say, well, it's too expensive to buy it here. And that's absolutely not the case because this is the beginning of it. We're in the second or third inning of this. People have a very difficult time with that. And so you read a book like Reminiscences, which is, arguably about Jesse Livermore. And it really is about, there's just some great stories in there about paying up for stock to prove itself coming out of these big resistance areas and starting to really mark up. And he would say things like, I got a terrible fill on that trade, which showed that I was absolutely right. It's like he took this horrible fill that he got as confirmation that the stock is in strong hands and it's difficult to buy and to own. And so as soon as people start to get a little bit of a profit, they want to sell their positions.
Yeah.
The trend is absolutely where all the opportunity is. Wyckoff, it establishes that, it's like, hey, this should be a really good trend. Now, maybe some of them don't work out. Certainly, I've had my fair share. But once you got a tiger by the tail, you just don't let go. And what people want to do, though, is they immediately want to psychologically get the self-gratification. And in fact, Druckenmiller tells that very story in this interview. It's a great story about NVIDIA. He's like, he'd made a huge gain on it. And he's a big trend trader.
Yep.
And he goes, it was like at $800. NVIDIA was at $800. And so he sold a big part of his position. And he was so proud of himself. He tells the story. He's so humble. I love the guy. And he goes, and within a few weeks, it was at 1,500. He's been in the business forever. And he was just, it was painful,
I was going to say, there's nothing more painful than that Druckenmiller story you just mentioned, right? Selling and feeling great for just a brief moment, and then watching, on the sidelines as the gains just continue to compound. What,
That's right.
with the number of the examples that you're talking about, I'm curious how you would describe the time frame upon which the Wyckoff framework, the Wyckoff method, is best applied. When you're analyzing charts and applying a Wyckoff framework, are they daily charts you're looking at? Are they weekly charts? Are there certain periods of time where a certain phase would need to take, or is it more just about the supply and demand dynamics?
Such a good question, because Wyckoff is very fractal. My personal preference is I like to look at daily and weekly timeframes.
Mm-hmm.
So it's like, I really do try to be in sync with the composite operator mindset and try to, identify them and follow them. That's all we want to do, is we just want to follow them. We don't want to get ahead of them. This is a business about being in the moment. In my world, I'm always telling myself this, and I say it all the time: reasons are optional. It's just the charts talk to me. They tell me what I think they're saying is what's going on, and then I act on that. I don't know one widget from another. So I just follow that. But daily, weekly time frame, I'll look at monthly time frames. I'm looking for big causes, really big causes are really intriguing, difficult to trade because they take so long to build. And I've written about some of them in my blog posts. But also it's very fractal. You can look at the intraday time frame, and you can see all the characteristics of accumulation, because it happens in every time frame. There's CO types in the short-term time horizons. And you don't know that these CO types who are building, they have these great trading desks. I'm sure that, many of these people, and you could tell many stories. These people are very, very good at what they do at accumulating these shares. And their behaviors, what they're doing will show up on the intraday timeframes.
Interesting. Yeah. So it really does have that fractal nature. And it reminds me like Elliott Wave, right? Elliott and others have talked about that same kind of fractal nature to some of those patterns. I'm curious. So if Richard Wyckoff was alive today and looking at a chart of the SOX, right, the semiconductor index, would he describe that as one of those we're grabbing the tiger by the tail, we just don't want to let it go kind of situations? Or how would you describe? Because I know that's a trade that for many feels like we've missed it. How does that, what would that structure look like as just an example of how we'd apply it in a current situation?
I was just going through many of those stocks yesterday, and the reaccumulation structures that have formed in the last few months in many of these semiconductor stocks are textbook. And so reaccumulation, and I write a lot about that. And as a matter of fact, we're working on putting all those posts together and turning it into a book. So this is a current project that's going on. And but you can just go and read them right on stock charts. So you can see how a reaccumulation structure will start. You can see the hinging action. You can see the absorption characteristics, and you can see that stock is being bought. And typically reaccumulations take less time. And part of the reason they take less time is because the stock is already deeply in strong hands. So what they're doing is it's like a mopping up action. It's like the trader types will, sell stock, and they'll cause a temporary pause in the market, and the strong hands will come in and absorb those shares. Now, having said that, you can have a final upthrusting action, and it can result in a distributional structure. But patience is an amazingly important thing in our line of work. And right. And so distribution is a process that takes time.
Yeah.
And, typically you can't have a big move without a cause. Mm-hmm. And so in the case of, say, the semiconductors, when they conclude, because they are in such strong hands, that the large holders that hold these stocks that have had beautiful campaigns in them will need time to distribute their stock. And that is what creates a distributional structure. So distribution occurs. There's some very distinct differences between distribution and accumulation. But on the schematics, which you can see on my blogs, they look like mirror images of each other. Okay, accumulation, distribution. But there's very distinct differences in how they unfold, the phases. So we say there's 5 phases of distribution. You stop the advance. Then you see the first sign of supply, large supply present. That tells you that this is the place where the CO is going to start selling stock. That buying climax tells you this is the point. This is the opposite of the value zone. This is the sell zone. And so the stock may climb above temporarily that buying climax area, but you just draw a horizontal line across the top of that buying climax, and there's your resistance zone. And the stock will just stay, might pop above it. It'll come right back in, and you draw support under what we call the automatic reaction, which is that huge supply dump that occurs after the buying climax, which is temporary. And then now you have the boundaries of where the distribution is going to take place. And the CO is going to do everything they can to keep the stock in that zone until they've sold out their entire position and maybe are short. We can see it. We can see the phases, A, B, C, D, E. We can see the phases and the characteristics, and we know the characteristics of how price and volume will relate to each other.
I so appreciate you talking through that, Bruce. Puts the semiconductor move into context, but I appreciate you talking about the signs of distribution. And I would echo what you said. Your blog at stockcharts.com is very well written, and I would encourage people to follow your work there, because you shared generously with examples illustrating some of these points, which I think would help. I know you also do a lot of work with Ramon at Wyckoff Analytics. Can you talk about the education you guys are trying to do there?
Well, Ramon was one of our students in the 90s. Hank and I had him in a class, and you come across people that just have true burning desire. They have true passion. And Ramon was one of those people right then and there. And he's gone on to become, probably the premier educator in the.
All right, so I think that's enough of that. Yeah, there's people that just love to trade just for the sake of trading. They love the game. This is a game for a lot of people. For me, I mean, it's a way for me to get cash, right? When I don't have a job, pretty much. But it's also like it can be fun. Yeah, I don't doubt it. A lot of people, they do have this kind of like, oof. I guess I just love trying to figure out the markets. It's just like you're fighting against your psychology, everyone else's psychology, but also the game is more multifaceted. So I'm going to play some videos about options now, okay? How options affect the market. But before that, let me share this. Let me remind you, okay, since Kyle mentioned SanDisk. So this is one of the things, I've talked about before. Okay, so let's say SanDisk, $25,000 in SanDisk would have made you a millionaire if you bought it a year ago, right? SanDisk is about up like 3,500%, something around there, 3,000 something percent in 1 year. Okay, let's say you are a trader, all right? You're not going to buy and hold something for a year. Okay, so let's say you have 250 trading days a year. All right, so there's no 24-hour trading yet, but we might have 24-hour trading sometime down the line shortly. And then we can divide it up to 62 trading days a quarter. And let's say I limit myself to 20 trades a quarter. I basically cap myself and say I don't want to overtrade. One problem I've seen a lot of people make, a lot of mistakes people make, is that they overtrade. They always feel like they have to do something every day, right? Which doesn't necessarily have to be true. If there's nothing to do that day, you don't need to trade. So let's say you're this active type trader and you want to make some certain amount of trades every year, and then from there you make your money. Okay, let me say that I want to be able to get about a 10% gain on each trade. And then every time I make my money, I take my profit plus my original capital and then trade again, right? So I'm compounding it. Let's say I start off with $1,000. So if I'm successful and can get about a 10% trade, a gain every trade, this is what would happen. I would make about $6,727.50 per quarter. Now, every quarter I reset back to 1,000, so I don't let that thing grow any further. So I'm trying to be cautious here and go like, well, I don't want to suddenly balloon this up to $1 million and then be like, and I do one trade and I lose 10% and then I start losing because it's hard to get 10%. Believe me, you think 10% consistently is very easy. I'm talking consistently. So every trade you make, you get 10%, right? 10%, 10%, 10%. Okay. You think your psychology isn't going to freak out once you start losing, when you make a lot of money and then you start losing and you're on a losing streak? That's a whole nother game. All right. Then you are psyching yourself out. So based on psychology, let's say you limit yourself to 20 trades and you reset it in the next quarter after 3 months back to $1,000. Okay. You're with me so far. All right. So my total profit for the year is basically 4 times $1,000 times 1.1 to the power of 20 minus $1,000, the starting capital. So after a year, I make $22,910. So $22,910 from $1,000 starting ain't bad. But can you keep that 10%? We already went over like the case where you cannot get what's the probability that you get 10%, right? Is it 60-40? Is it 50-50? That's not going to cut it. You're going to basically need 99% or something, 99.9999%. That's not going to happen either. But you got to have some good way of making sure you get consistently 10% each time and do this game. And then you could turn 1,000 into 22,910. And then later on, I could turn 10,000 into 220, right? 1,000 basically. And then again, I could do it again with, I could keep growing every year. So is that possible? Is this possible? I would say this is very hard. But as a thought experiment, you can see how easy you can do this as long as you could figure out how to do. So this is the abstract equation down here. So, you could do like X equals $1,000, G equals 0.1, K equals 20, and then you can make plug this in yourself, and then you can change what X, G, and K is. And then if you want to add more variables, you can go like, okay, 0.6 is like the 60% that I get the 10%, and then 0.4 is that I lose 1%. Let's say I have a stop loss at, you could increase the complexity of this thought experiment as far as you want. But I can make like $1 million off of like $1,000, if I adjust all these variables and get it to that point. So there you go. But obviously that's not going to happen, right? This is an ideal case. All right, let's talk about options. Okay, so let's play this video by Jem Carson. Okay, so if you don't know this guy is one of those geniuses in options. Okay, so this guy loves options. He breathes options. And I think it's good to hear him talk, Okay, let's see. So bear with me, because I had to do multiple screenshots of this because of their Vimeo, because they were using Vimeo to stream it.
Series. As always, I'm joined by my colleague Craig Payton, our in-house Greek specialist, and by Jem Carson, founder of Kai Volatility Advisors and derivatives expert. So we'll begin today, as we do normally, with some
Video's not playing right. Okay. This could
be the options markets that can influence.
Okay, this could be a StreamYards thing. Hold on. or maybe the video is corrupted somewhere. So like I said, I had to do what
in terms of volatility.
This.
All these factors, let's remember, play a role in shaping investor demand and product design, and ultimately influence the type of exposures being created in the market. And from there, we'll move to what is really the core of the session today, the S&P 500 and mechanical buying. And by this, we mean hedging flows generated by the options markets that can influence the direction of the underlying benchmark, sometimes independently of traditional macroeconomic or fundamental drivers. And we'll also spend some time on some of the mechanics behind this and how these sensitivities evolve as the market moves. Understanding those concepts, of course, is critical to understanding why flows can become self-reinforcing. So the aim today really here is to provide a...
Okay, so do I have to translate that to English? What this essentially is saying that derivative markets drive the underlying markets. So the tail wags the dog. We've talked about gamma before. We talked about all this. I don't do options trading, but the options market is a huge, huge factor in the modern stock market. Okay, along with futures. All right. So you can see how futures are influence the market as well in the overnight markets, right? So all these derivatives, all these instruments that derive their price from another price actually now have an opposite effect where it influences the spot price. Okay, so that's why you have a lot of people complaining about paper gold, paper silver, paper oil. Yeah. Well, that's the reality of the situation. The paper markets control the actual markets. So even in stock markets, there is a derivative. So an abstract is created out of thin air, a contract. And this is how everything moves now.
More intuitive understanding of how these dynamics show up in real market conditions. And finally, we'll move on to Gem's crumbs, where Gem will share selection of additional observations, data points, and perspectives that don't necessarily fit into a single theme, but are highly relevant, obviously, to how the market is evolving and to what we're going to be talking today. I encourage you to ask questions. We'll have some time set aside at the end for some questions, and if they're relevant, of course, we'll answer them kind of as we go. So I actively encourage you to remember that. So, without further ado, let's start with who we are, SRP and Kai Volatility. So, for those of you who've listened to us previously, SRP, we are a 24-year-old provider of structured product data and intelligence. And we have a database of over 55 million products, both live and expired, covering all markets globally. And obviously the team behind that to kind of support that data. We recently launched a Greeks product, which looks at the Greeks sensitivities for some of the most liquid, some of the key underlyings in the structured product market. So S&P 500, obviously, because we're going to be talking about it today, but also Magnificent Seven and a number of other key global benchmarks and single stocks as well. So that's for SRP. Gem, would you like to tell our listeners a bit more about you and what it is that you do?
Absolutely. Thanks for the intro. Jem Carson from Kai Wealth and Kai Volatility Advisors. Sorry, we had a microphone issue there. I was one of the biggest market makers in the S&P 500 and equity index and equities writ large during the Great Financial Crisis. And we run a non-correlated wealth advisory business, as well as products that help clients manage kind of market timing and hedging throughout market cycles. So kind of a vertically integrated advisory for family offices as well as for institutional investors.
Excellent. Thank you, Jem. So as I said in our agenda just before, we'll start with a sort of brief setting the scene when it comes to activity Q1 of 2026 year to date. So I'll start with sort of 5 key points, 5 key trends that are really outlining the market today. I think I said I said something quite similar in the webinar that we did before when it comes to global issuance rising. It is rising again, up nearly 20% versus the first quarter of 20.
All right, maybe this is another point where the video gets corrupted. I don't know. Let's see. Come on.
more capital protection
Okay.
ETF, auto call ETFs as a wrapper that are really emerging. And something that emerged from a webinar actually that my colleagues Pablo and Nikolai gave about a month ago for our Europe conference. Off the back of that, demand for products with longer dated tenors, more capital protection, and downside protection as well, kind of reflecting current market dynamics. I've chosen three of the biggest markets when it comes to the S&P 500 for our next three slides. Somewhere we're seeing the most products issued and the most notional on that particular benchmark. So next slide would be when it comes to the US. Obviously, this is total US activity, not tied specifically to S&P 500. But here you can really see that March 2026 was the busiest month in terms of issuance. And again, you can see that the market's trending upwards on all fronts. We've seen a number of new issuers actually in this market in the past 12 to 18 months. Not naming names, but we're looking at between 3 and 5.
All right. Breaking news. IREN is up 26% after market. Okay, we're good, man. We're done here. So we got Core Z, we got IREN, we got CIFR, we have APLD, we have HUT. Everything has reported for that area of the market. Okay, so that means tomorrow into next week, the decision will be made to dump everything into the best ones. I'm trying to pick the two of the best ones. Hopefully, we can determine very quickly what the number two is. Maybe it's APLD or CIFR. We'll see how it goes tomorrow, okay, in morning. Or we have to wait for Monday. So that will be great. We got the pump right there. We're finished here. Okay, pump. So that means IREN wins. HUT wins. HUT was up 35%. And then CIFR was up, what, 20 or whatever percent. I don't remember too. So that's great. Perfect. Okay, guys. So IREN is up. Now we will talk more tomorrow. I think that's all we'll have to focus on for the rest of the month. Don't look at any other stock except for those. Okay, IREN, APLD, and then CIFR, and maybe Core Z. Okay. So that's in summary of what I talked about at the beginning of the stream. Okay, that's it. So that's it. HUT, IREN, APLD, CIFR, and maybe Core Z. But I think I'm only going to do two of these from now on. And if I'm only going to do two of them, it's going to be leverage from here on out. Okay, guys? So if you remember, that's what Bruce Fraser said. When you get scared to buy, it's time to buy. It's going to get really scary really quickly on those stocks.
I believe new issuers that are hitting the market, and as I said, the ETF wrapper really taking off there. I think about a bit less than a year ago, I think we saw the launch of the first auto call ETFs. Next market I'm talking about is Switzerland. So over here in Europe, big markets as well. It's a big yield enhancement market. Also seeing a number of sort of new structures, including actively managed certificates, AMCs, kind of hitting that particular market, as well as rising demand really for foreign exchange linked products. This is kind of coming on quite strong, and a number of payoffs really that are dominating include Phoenix, reverse convertibles, and Athena structures. The final market I want to focus on is Korea. Not a market actually that we typically talk about. It's a market we cover obviously with our data, but we cover as well with our Greeks product. I thought, given that it's in the kind of top 5 markets when it comes to using S&P 500 as an underlying, I thought it might be interesting to kind of have a bit of a look at that. So again, Q1 issuance is nearly 30% higher than the same time last year there, and notionals as well are jumping quite significantly here. Just to let you know that you can see the December 2025 spike. It's not a blip. It's not an anomaly. I think there's some activity that often happens. Talk about some market we cover obviously with our data, but we cover as well with our Greeks product. I thought, given that it's in the kind of top 5 markets when it comes to using S&P 500 as an underlying, I thought it might be interesting to kind of have a bit of a look at that. So again, Q1 issuance is nearly 30% higher than the same time last year there, and notionals as well are jumping quite significantly here. Just to let you know that you can see the December 2025 spike. It's not a blip. It's not an anomaly. I think there's some activity that often happens end of year in Korea, which explains the kind of quite dramatic rise that you can see here in notionals and sales volumes. It's normal. It happens every year about that time. But if you look at the sort of general trend here, if you look at sort of January, February, March, we're seeing kind of sustained activity compared to last year. And something to note here as well, S&P 500 is tied to roughly 17, nearly 20% of investment flows for in the Korean markets.
All right, you hear that? So that's what I suspected. I suspected that the S&P 500, the US market, is now tied to the Korean market. 17% of the flows are going between the two.
That's the end of my data heavy kind of chat. Craig, I think you had a couple of other stats that you wanted to share with our listeners.
Yeah, thanks, Emily. What's really interesting is the growth we're seeing across some very key markets, and some of the numbers that I was looking at, thanks to our data team earlier, was just around alt-call structures. It looks like we'll hit $1 trillion in total notional in alt-call structures this year. NVIDIA comprising 90 billion, close to 100 now. That will probably be the first single name with outstanding notional of over 100 billion purely on its own as an underlying. And then the overall market, as you were mentioning earlier, 2.6 trillion. It's compare those numbers sort of 3, 4, 5 years ago. It's a very big increase. It just shows the demand for these types of structures, the diversification that we're actually seeing, and sort of leading into that, Jem. With that numbers that I was just explaining there, what sort of do you see is driving that growth specifically in the structured product market, but then obviously the derivatives ecosystem sort of writ large? The numbers that we're seeing there are increasingly getting bigger and bigger year over year, month over month, and even week over week. What do you think sort of driving that, and how does that impact some of the underlyings as well?
Yeah, 4 or 5 years ago, we came out and we were very clear that if we started to see an increase in structured product issuance, and that was a significant increase from previous levels. And what became clear to us as we went through 22, 23 was that it was very tied to two main forces. And these two forces, in our view, are quite secular. One is a secular rising interest rate environment. Structured products themselves, if you're getting 0% underlying on the yield part underneath the surface, as a relative value to a value proposition relative to an equity investment or something else, doesn't really, it's not as good a value proposition. Right. But the second that 10, 20, 30 year, or the 2, 5 year bond is as well go to 4.5%, 5%, completely different equation, right? And so that's a major driver. And as we've seen recently, again, with the prices of oil going up, again, the 10-year secularly, unable to break back down and going higher, that continues to be a value add. Related and similarly important, the forces that are driving from a macro perspective, those higher interest rates are also driving broader geopolitical, broader macro risks, which drive a desire for more non-correlation. And that non-correlation we're seeing, that desire for non-correlation we're seeing, and we talked again and again, back into 22 even, has shown itself in precious metals, right? It's shown itself in crypto as assets, but it showed itself in hedge fund assets, which went from $2.25 trillion all the way to 4.5, now close to $5 trillion now in the last 3-4 years. Options volume broadly, which are tied into these structured product issuance, also same dynamics, and the growth of ETFs with structured products somewhere. All of these things are related. And again, we painted this picture before, but I want to be very clear to everybody that's listening. You have $500 trillion of long assets in the world, give or take a couple tens of trillions of dollars. And we're talking about a growth of all of these things I mentioned: hedge funds, structured products, ETFs with options, structures in them, crypto, precious metal, all of these things going from investments of 7 or so trillion all combined to something closer to 20. But in the grand scheme of things, as non-correlated assets, these are a tiny fraction. All these non-correlated type exposures will eventually go to, 100 trillion if what I think is happening in the world continues. So this is still relatively early innings, but that is in my opinion.
All right, so we are in early innings, my friend. That means if this keeps going, so you look at this slide, mechanical buying in focus. Why markets can move without significant macro events happening. Okay, so that means every time Trump tacos, they just buy. They just buy. It's like a wrench where you're just cranking it up, right? You're just cranking. That's it, man. This is all that is. So option hedging flows can drive the direction of underlying independently of market fundamentals. Fundamentals don't matter. So that's all we've been saying, right? So we've been saying psychology is what drives on the technical side. So if we look at the technical charts, we can imagine it as if it was psychology, right? That's driving the markets. But now we also have the help of options. The options is driving the markets up. So even if nobody real is buying, all the algorithms are just pushing the crap up and up and up and up just because of a certain options pricing regime or whatever we're in. I'm not an options expert. That's why I listen to this guy and he'll tell me. So that's what's happening. Structured products and options create forced buying and selling. Feedback loops when flows can influence market movements. So all these things can push the market higher than you think could be possible. Okay. All right. Okay, let's go on to the next section. This will be the longer section here. The talk.
Okay. Is, in my opinion, the things that are structurally driving these outcomes.
Thanks, Jem. So we're on the slide where we kind of give a very a brief intro to what, to a definition of what mechanical buying is, and why actually it's relevant in our market. Just before we go to the next slide, we obviously chose the S&P 500 as our case study today for this particular mechanical buying. So as we've kind of discussed briefly, S&P 500's benchmark heavily used in structured products globally. It's been the most liquid one, for a number of years now. As Craig mentioned before, large outstanding notional attached to that particular index, and has as well some concentrated strike dates with for products linked to that particular index. So we really sort of wanted to focus on that. The second part of it is why we want to discuss mechanical buying today. Craig, when we had the discussion about the agenda a few weeks ago, I think you came up with this and why it was relevant. Do you want to sort of share a bit more why you wanted to kind of focus on this today?
Yeah, absolutely. Thanks again. There's a great question that actually just come in, so I will pass that across to Jem as well, just after my quick 30 seconds. March 31st, we saw, I think, a 3.5% increase. Now, obviously, just picking that day, month end, rebalancing, and I know it's not sort of a one-day thing, it's a process. But there was subsequent articles as a result of that significant move. And obviously the fundamentals do play a side in that, with the Iran war, with the news that was simultaneously coming out with that as well. But the mechanical nature of the delta hedging and the impacts that are being driven by the derivatives market, we're seeing more and more, thanks to the volumes that we're seeing in the structured product market, futures, options, you name it, we're seeing a lot more of this mechanical nature. Dealers, they have to buy, they have to sell to remain delta neutral and to remain even on their books. What does that do to the actual underlyings that people have positions on? Everyday traders have positions on, big institutions have positions on as well. And if these volumes continue to increase, just like with the structured product market, the 0 day to expiry options, the volumes that we're seeing from all of the exchanges, what does that do to the underlyings and the trading opportunities, Jem, within that? And how does that continue to unfold as we do continue to progress through this type of environment? And I will ask that question that just come in after, so if you just give just a couple minutes, if that's okay.
Absolutely. So the big picture here, and not to speak specifically to just specific structured products, but in terms of broad market positioning, I think that March 31st example is incredibly important. One massive options trade, which is, again, this is not a structured product, but is this JP Morgan hedged equity trade, right? And that rolls at the end of the quarter. A lot of structured products roll at the end of the quarter. A lot of ETFs, other structured positions also do as well. And so when these positions are very concentrated at certain expirations, particularly when the market has moved, much like it did into March 31st, right to strike of a big position, you start to have dramatic effects relative to everything else. I would argue the movements we saw on that 30th into 31st, and we'll get to kind of some of the geopolitical things that kind of played into it, which I think are actually related, which we'll talk about in a little bit. But when you start to move into those strikes, the market becomes much more sensitive to movements through and near that strike. And as we know, much like with these, these autocallables on the downside, when you hit a certain point, there's a hedging problem for institutions. They're getting to the last day. Is it going to be in the money or not? This creates massive issues. The JP Morgan hedged equity trade had a massive, 60,000 SPX position, almost exactly at strike. We went through it, which was short gamma for dealers, right? And then went completely to the downside, and then completely again went the other way. Why? Because as we went through it, all the dealers were forced to sell deltas en masse, right? And as you go, start to turn, and the administration kind of creates a situation where the market turns. Now, instead of maybe having a 1% effect to the news or 1.5%, you get a massive V move through. End of quarter, you highlighted as well, drives a lot of other flows into end of quarter. So that move and the immense amount of gamma, short gamma in the market was 100% tied to these structured products, some of these ETFs and collars. But if you don't know what's going on there, if you don't understand what the strikes are, what the positioning that is, you're really caught looking at these moves almost quizzically, like why could the move be that big? CNBC will give you the news and the geopolitical story after the fact of why it happened. But the reality is there was so much forced buying into the close of trading on March 31st based on that short gamma and that positioning. And that really is what drove that dramatic kind of V bottom. I will highlight, much like a game of poker or anything else, you need to know, first and foremost, what is the power of a card at the table? What are the positioning? What does that mean? That information allows you to be statistically kind of the best card player you can be, the best trader you can be. But you also, as a secondary level, have to play the players at the table. And you have to appreciate that the Treasury and whatnot are also looking at these things and understanding these dynamics and using them when appropriate for themselves to manage markets as well. That's my view. And so I think that had something to do with it as well. But I think, again, first order, if you don't know what these positions are and those effects, starting here and going all the way through all kinds of positioning, you're really playing at a major deficit.
Yeah, that's a great point. Structured products is one of many areas, but it's a growing area of important significance given sort of the volumes. And there's always a story to a move, isn't there?
Exactly.
That's what happens. The question I do want to actually get to this is I do think it is quite a good one. Jem, are we in a roll up, market up, melt up? Sorry for the many ups there. How will this end given record options volume and leverage? Will the US market be similar to Indian market where options trade more than the underlying? And I highlight that question specifically because of the last 15 minutes. And I will ask you just to be a couple minutes on that because I don't want to give too much away from the crumbs, as we will definitely be getting to that as well.
Absolutely. I've highlighted this at length, but I'll try and be very specific. Options are more precise. End of story. You can have a two-dimensional up-down asset of any kind, right? Where you're taking on all the risk of the full distribution of an asset, or you could take any piece, any moment of the distribution, both 1% out of the money, 2% of the money, 5% of the money, 10% of the money, in either direction at any point in time. Options allow you to segment and be more capital efficient by not taking all the risk of the underlying and only betting on part of the distribution. It's that simple. So, of course, something that's dramatically more precise is better, assuming there's enough liquidity and enough access and enough capital, enough ability to operate within the asset or the product. So options are growing dramatically as a function of that as well. There's really just a greater level of precision, a greater level of ability to be more non-correlated and capital efficient, as we discussed before. That's what's underneath all of the structured product growth, all of the options growth. It's the ability to precisely package and position in a way that is more precise to the outcomes that you want from a risk-adjusted perspective. And so once you look at the world in that regard, it really has been a matter of network effects. Do we have enough volume? Do we have enough access? Do we have enough education? Do we have enough tools? And I would argue with the AI piece, the ability to better understand and get clear payoffs, the growth of the industry, whether it's banks and structured products, the technology that they offer and the clarity of education they offer on these products, we get to a point where that growth is going to eventually eat, the two-dimensional asset world. People thought I was crazy when I started saying that 4 or 5 years ago. Again, I want to be clear. People think that's a little less crazy these days. People eventually move to superior technologies, much like electricity. People thought of it as lightning. How could I ever bring lightning in my house? That sounds too dangerous. It took standardization. It took the ability to simply for people to plug into a plug and use what is a dramatically better outcome, a technology. And so we've hit those network effects, and that's why we're seeing these really kind of meteoric growth paired with the demand driven by higher interest rates and non-linearity as well.
So to sum that up, it's basically like as we move on in the future, more and more people are just going to use options. That's essentially it. And if they don't know how to use options, they'll buy ETFs that already do options. I mean, Kyle already mentioned it yesterday, right? You have a covered call option strategy ETF for Bitcoin. That's already out there. And more people are going to use that. And that means that's going to create more demand for options indirectly. So they will buy these ETFs. They will create more options for every person that buys a share of that ETF. And they'll create more of this mechanical flow. So no, Arcade Pilot, are you talking about Delta Airlines? No, we're not talking about that. Delta, Vega, these are the Greeks of the option world. These are actually letters, I guess. Vega is not a Greek letter, but, well, they make up their own letters, I suppose. Okay. I don't know why she's bleaching it, but all right. Very good to know, I suppose. Yeah. Greeks in the Greek sense, or even not so Greek sense, because Volma, Vega, those are not Greek letters.
I know we said that we were going to keep some questions, on the side for the end, but we're getting some good questions in, and I feel that I think that the one I'm going to ask you now, Jem, is really kind of relevant to what we're discussing and kind of follows on a bit from the one Craig asked you a few minutes ago. So thank you to whoever asked this question. So question is, if structured products are unlevered and uncorrelated, what's the risks to markets? Will the vol supply from these products be a permanent and prominent influence on markets, or will it blow up one day and investors in these products retreat?
The answer is somewhere in between, as all the good answers are, right? I would argue, if you look back to other periods in history where we see the structural macro effects, like we're seeing now, that are more likely to trend towards the populism and the structural effects that are likely to drive higher interest rates, more nonlinear outcomes. When we see periods like this, historically, we tend to see more volatility in the short term, right, with less longer term volatility. And some of that is because of the assets. Most assets are traded nominally, so at some point, the reduction, right, in the asset value in real terms underpins the long-term volatility. But we could get to all that in another conversation. But the big picture is, historically, volatility increases across assets in the short term, and you have more nonlinear outcomes. That said, in this world, we're now for the first time entering a period like this with reflexive effects of things that are now available. Right? We didn't have options, and the options exchanges were open in the early 1970s. Right? We didn't have a lot of the not just structured products, but any types of non-correlated strategies and things that we have now. And so the demand going into them is reflexively, I believe, going to have a vol dampening effect, right, in the face of a geopolitical reality that is broadly more stressful and poor from a multiple perspective and other structural perspective. And nowhere can you see that more than the last month and a half, right? We see the structural geopolitical realities. We see the long end of the curve going higher. We see the price of oil going higher. We see global conflict and the breakdown and supply chains in front of us. But markets are reacting a little bit differently, right? Mm-hmm. And so much of that is tied to these reflexive effects. And as if I'm telling you, these things are just getting started and this is just going to continue to grow. You're really going to experience this really, I think, different push-pull in markets. I think the distribution of markets and how they move will be very different, let's say, than the 60s and 70s, despite, I think, a pretty high probability that we head to a broad market direction that looks more like the 60s and 70s, like from a structural perspective. So there's going to be some very different push-pull realities in this market, which, in my opinion, what does that distribution look like relative to very discontinuous? You have situations where vol is very compressed, not much happening, and one day you wake up and markets move dramatically. And the difference between when they do it and what they don't could very much be highly tied to, as we highlight on March 31st, what positioning is on that day or that moment, and how offsides or concentrated positioning is, which opens up the window. So these are not just things that are important to understand from a one-day flow perspective, but structurally what this will mean broadly for market movement, I think is very much tied to these positions. So to more directly answer the question, yes, these are going to change market outcomes broadly. It will compress, I think, index level volatility. And as we're seeing, though, where that structured product issuance is important, because yes, like maybe implied vol at the index level at the S&P is very compressed right now. But for the AI part of the market that's up 50, 60, 70% in a month, vol's not very compressed. And so if anything, it leads to dispersion, increased volatility in parts of the market. And more than ever, geopolitical macro outcomes will drive also more dispersion across assets. So understanding those dynamics, not just at the index level, which we tend to focus on, but what that means now for underlying constituents is also going to be critically important.
I think that's what we discussed on the previous webinar, if I'm not mistaken. So if people want to kind of refer to that, it's available on our site as well, webinar number 2, where we discuss some of those topics. Just to remind everyone again, if you want to ask questions, just to not be scared to do so, we'll address them at the end. Craig, do you have anything to add before we move on to Gem's crumbs?
No, I'll just try and set the scene, as I know things do certainly get a good wrap online, and a lot of participants are definitely interested into sort of what you say, Gem, for the next 10-15 minutes. So I'll just try and set the scene. I'll try and do it as best as I can, and then definitely hand over to you. Where markets are now, I'm just looking at my screen. The 10-year at 4.5%. Equity markets all-time high. Gold's 3% at 4,700 right now. Oil down 8% on the day to 96. The dollar index at 98. BOJ intervening what it seems like every day this week, or certainly quite a lot this week. The Iran conflict looking like it might be wrapping up, but again, the rhetoric surrounding that can change by the time I finish talking in the next 30 seconds. But where do we head from here? What do you see unfolding in? Again, I'll sort of try and frame it in sort of the short, medium, and long term for the remainder of the year. With the current setup of the market, the current administration, the current interest rate environment, the new Fed chair coming in as well soon, how do you see markets unfolding with such dislocation, diversification happening, not at the product level, but at a geopolitical level? Where do you see the markets heading towards, and the impacts that will have on the actual equity markets and other markets writ large as well? I know that was quite a lot there. So
no, I think that's thank you for setting the scene. I think that's a great lead in. As I broadly tried to allude to, what's critical here is not to speak over simplistically about markets. Markets are not just the S&P 500. There is a dramatic dispersion of outcomes happening across the world, across different assets, right? And even within equities writ large. That I can assure you will continue. Why? Because there is this dramatic push-pull between geopolitical stress. Imagine there were no markets. Imagine they just didn't exist, right? That we had no sophisticated markets in this world. Is this a time of geopolitical stress or not? Clearly, the answer is yes, right? We are 40% of the flows of energy, the biggest input to all businesses in the world, is being disrupted and ground to a halt. The flows going to Asia, right? 20% of all global flows have just stopped of energy in the world. We are in a proxy war between the number 1 and number 2 biggest economies in the world, right? So when you start at that level and you start looking at what's happening from a big structural perspective, there's very little doubt that what's actually happening is geopolitically stressful. And by the way, the actions, let's walk through the actual geopolitical actions of the administration. Again, don't look at markets for a second, but what has the US administration done in the last 6 weeks? I'm gonna list just 7 or 8 things. And what you're going to hear through this, and we're going to bring in the flows then, right, which are critical to this conversation, afterwards. What have they done? They have convened a special group on private credit to discuss the tail risks involved in the leverage on the tail of private credit. They have convened a special group on cybersecurity and the risks of AI, and they brought in JP Morgan, all the major banks in an emergency meeting. They passed the Jones Act, an emergency energy meeting with all the major energy companies in tow to help figure out how they're going to be able to increase energy output. These are all emergency meetings. These are not like standard meetings that we're having, right? We have passed an infrastructure bill to speed electrical and internal infrastructure in the United States and deem it critical. We have increased the defense budget from $1 trillion to $1.5 trillion. We're in the process of doing that. We have issued swap lines to the Middle East, right, en masse, to make sure that liquidity is still flowing, amidst this time. We have asked GM and Ford in an emergency to come in and to start re-gearing their production lines for defense equipment.
All right, so that sets up everything for the next war. Okay, guys, so we will continue this tomorrow. Anyway. Yes, Iran still up 20%. Okay, guys. So, and if we're gonna do leverage, here, Eric W put in all the tickers with the leverage. So, all right, good luck. Good luck. Let's see if we're winners for next week as well. Let's see if this sector is the one that will continue on up. I'll see you tomorrow.